The crisis had been contained, but not resolved. Banks had failed. Credit markets had frozen. Trade had slowed across continents. The system survived only because governments moved at historic scale. In 2009, in Washington, D.C., policymakers faced a problem with no precedent. Interest rates were already near zero. The usual tools were exhausted. Unemployment remained high, lending was weak, confidence was thin. So the Federal Reserve changed strategy. It began purchasing massive quantities of government bonds and mortgage-backed securities. Not with saved funds, but with newly created reserves. Digital balances expanded, the central bank balance sheet multiplied. This was quantitative easing. The goal was simple: lower long-term rates, stabilize asset prices, restore liquidity. Markets responded, bond yields fell, stocks recovered, banks strengthened. But something deeper shifted. Investors learned that when stress appeared, liquidity would follow. Asset prices began reflecting intervention as much as fundamentals. Money was no longer constrained by metal. It was engineered. Growth returned slowly. Asset values climbed faster. Wealth concentrated unevenly. Debt remained central to expansion. The system had evolved again, from gold discipline to sovereign control to liquidity management. So the question sharpens. If stability depends on continuous intervention, what happens when intervention becomes normal? Watch. Listen. Remember. Follow and subscribe to Lost in the List.